Good morning, everyone, and welcome to another edition of Market Meridian. I'm your host, Eric, and today we are zooming in Australian dollar to US dollar. As we kick off this live broadcast on April 23, 2026, the Aussie dollar is sitting at a critical juncture, shaped by a perfect storm of risk sentiment, economic data, central bank policy, and commodity dynamics. Let's set the stage with a quick recap of where we stand right now. As of 8 a.m. Greenwich Mean Time, Australian dollar to US dollar is trading at 0.7159, with a slight gain of 0.1119% on the day. The pair opened at 0.7147, matching yesterday's close, and has already seen a high of 0.7176 and a low of 0.7144 in early trading. For those of you who missed yesterday's session, let's do a quick recap to understand the context behind today's movement. Yesterday, April 22nd, the Aussie staged a mild recovery, closing at 0.7169, a 0.33% gain, driven by improved risk sentiment, a weaker US dollar, and ongoing support from the Reserve Bank of Australia's hawkish stance. The day was marked by a small bullish candle, with the pair consolidating within a narrow range, setting the tone for today's session. Global risk sentiment is the backbone of the Aussie dollar's movement today, and it all starts with the latest developments in the Middle East. As many of you know, tensions between the US and Iran have been a major driver of market volatility over the past 2 weeks, with safe haven assets like the US dollar, gold, and the Japanese yen benefiting from heightened uncertainty. However, yesterday brought a glimmer of hope. Reports emerged that the temporary ceasefire between the two nations has been extended until April 26th. If negotiations progress smoothly and there's a sign of a more permanent resolution, risk sentiment could improve further, giving the Aussie an additional boost. To add another layer of complexity, we are also seeing a rise in oil prices this morning, with WTI crude breaking above $92 per barrel. This rise is driven by concerns over supply disruptions in the Middle East, even with the ceasefire in place. Higher oil prices stoke inflation fears, which could impact central bank policy decisions, particularly for the Federal Reserve. If inflation expectations rise, the Fed may be forced to delay its planned rate cuts, which would strengthen the US dollar and put pressure on the Aussie. On the flip side, higher oil prices also benefit Australia's energy exports, which could provide some support to the Aussie. It's a delicate balance, and one we'll be monitoring closely throughout the day. Another key indicator of risk sentiment today is the movement in global equities and commodity markets. Overnight, Asian equities closed mostly higher, with the Shanghai Composite Index gaining 0.8% and the Nikkei 225 rising 0.5%. European markets are also trading higher in early session, with the FTSE 100 up 0.3% and the DAX gaining 0.4%. This institutional buying pressure could provide additional support for the pair today, especially if risk sentiment remains positive. Now, let's move on to the second major factor driving the Aussie today: key economic data releases. Data is always a critical driver of currency movements, and today is no exception. We have a packed calendar of releases from Australia, the US, and the Eurozone that will likely cause volatility in Australian dollar to US dollar. Let's start with the data that's most directly tied to the Aussie: Australia's April Manufacturing and Services PMI. Economists are expecting the manufacturing PMI to come in at 49.8, which is just below the 50-point. The services PMI is expected to be even weaker, at 46.3, which would mark a continued downturn in the services industry. These expectations are reflective of the broader economic slowdown that Australia has been facing in recent months, driven by high interest rates and weak consumer spending. So, what does this mean for the Aussie? If the PMI data comes in better than expected, especially if either the manufacturing or services PMI moves above the 50-point mark. It could provide a significant boost to the Aussie dollar. A stronger-than-expected reading would ease concerns about economic slowdown and reinforce the RBA's hawkish stance, as it would suggest that the economy is more resilient than previously thought. On the other hand, if the data comes in worse than expected, particularly if the services PMI falls further below 46, it could weigh heavily on the Aussie, as it would fuel fears of a deeper economic downturn and potentially lead to speculation that the RBA may need to cut rates sooner than expected, though it's important to note that the PMI data is a leading indicator, meaning it provides insight into the future direction of the economy. As such, it has the potential to move the market significantly, especially if it deviates from expectations. We'll be watching this release closely, and I'll provide real-time analysis as soon as the numbers come in. Next up, we have the US economic data, which will be released later in the day, starting with initial jobless claims at 20:30 Greenwich Mean Time, followed by the April market manufacturing and services PMI at 22:45 Greenwich Mean Time. The US data is crucial because it will impact the US dollar, which in turn will influence Australian dollar to US dollar. Let's break down each release. First, initial jobless claims. The market is expecting claims to rise slightly from last week's levels, with a consensus forecast of 215,000. Jobless claims are a key indicator of the health of the US labor market. Higher claims suggest a weakening labor market, while lower claims indicate strength. If jobless claims come in below expectations, i.e., fewer people filing for unemployment, it would signal a strong labor market, which could strengthen the US dollar and put pressure on Australian dollar to US dollar. Conversely, if claims come in above expectations, it would weaken the US dollar and provide support for the Aussie. The Eurozone's PMI data is also important, as it provides insight into the health of the global economy. The Eurozone's manufacturing PMI is expected to come in at 47.8, while the services PMI is expected to be 51.2. A weak Eurozone PMI reading could lead to a decline in global risk sentiment, as it would signal a slowdown in the European economy. This could benefit the US dollar as a safe haven asset and put pressure on the Aussie. Conversely, a strong Eurozone PMI reading could improve global risk sentiment, lifting the Aussie. Now, let's move on to the third major factor driving the Aussie today: monetary policy and interest rate differentials. The relative stance of the Reserve Bank of Australia, RBA, and the Federal Reserve is a key long-term driver of Australian dollar to US dollar, and today it's playing a particularly important role in supporting the Aussie. Let's start with the RBA. The central bank has maintained a hawkish bias in recent months, keeping its key interest rate at 4.1%. Market pricing currently indicates a 57% probability that the RBA will raise rates by 25 basis points at its next meeting in May, bringing the rate to 4.35%. This hawkish stance is supported by the RBA's concerns about inflation, which remains above its target range of 2 to 3%. The RBA has repeatedly stated that it is prepared to raise rates further if inflation does not cool down, and this commitment has provided significant support to the Aussie dollar. The high interest rate in Australia also creates an arbitrage opportunity for investors, who can borrow in currencies with lower interest rates, such as the US dollar, which has a key rate of 5.25 to 5.50%, and invest in Australian assets to earn a higher return. This so-called carry trade has increased demand for the Aussie dollar, limiting its downside and providing a floor for the currency. On the other side of the equation, we have the Federal Reserve. The Fed has been maintaining a restrictive monetary policy, with its key rate at a 22-year high. However, market expectations for rate cuts have been shifting in recent months. Initially, investors were pricing in multiple rate cuts in 2026, but recent economic data has been stronger than expected, leading to a delay in those expectations. Currently, the market is pricing in a 40% probability of a rate cut in June, down from 60% just a month ago. The Fed stance is a double-edged sword for the Aussie. On one hand, if the Fed delays rate cuts, it strengthens the US dollar, which puts pressure on Australian dollar to US dollar. On the other hand, the Fed's hawkish stance is driven by a strong US economy, which is positive for global risk sentiment, something that benefits the Aussie. Today, the balance between these two factors will be key, especially in light of the US economic data releases we discussed earlier. Now, let's turn to the fourth major factor driving the Aussie today. First, iron ore. Iron ore is Australia's largest export, and its price has a direct impact on the Aussie dollar. This morning, iron ore prices are slightly lower, trading at around 788 yuan per tonne, but they remain at relatively high levels. The slight decline is due to profit-taking after a recent rally, but the market remains supported by strong demand from China's steel industry. China's steel mills have been ramping up production ahead of the peak construction season, which has increased demand for iron ore. Additionally, inventory levels at Chinese ports are relatively low, which is providing support for prices. Overall, the iron ore market is neutral to positive for the Aussie dollar today. Next, coal and natural gas. The ongoing tensions in the Middle East have pushed up the prices of coal and natural gas, as investors worry about supply disruptions. Australia is a major exporter of both coal and natural gas, so higher prices translate to higher export revenues for the country. This increased revenue strengthens Australia's trade balance, which in turn supports the Aussie dollar. For example, coal prices have risen by 5% over the past week, and natural gas prices are up by 3%. This trend is expected to continue as long as Middle East tensions persist, providing additional support for the Aussie. Now that we've covered all the key factors driving the Aussie today, let's put it all together and analyze the technical picture. Technical analysis is crucial for identifying key levels of support and resistance, which can help us determine potential entry and exit points for trades. Let's start with the key levels to watch for Australian dollar to US dollar today. First, resistance levels. The immediate resistance level is between 0.7180 and 0.7185. This level was tested yesterday, and the pair was unable to break above it, indicating that there is significant selling pressure at this level. If the pair can break above 0.7185, the next major resistance level is 0.7200, a key psychological level and the year's high so far. Breaking above 0.7200 would signal a strong bullish momentum and could open the door for further gains, potentially targeting 0.7220-0.7230 on the support side. The immediate support level is between 0.7150 and 0.7155. This level corresponds to yesterday's low under intensive trading zone, so it's likely to be a strong support level. If the pair breaks below 0.7150, the next major support level is 0.7130 to 0.7140, which is another key demand zone. Breaking below this level would signal a bearish shift and could lead to further losses, potentially targeting 0.7100-0.7110. From a technical perspective, the pair is currently in a range-bound structure, trading between 0.7130 and 0.7200. The short-term moving averages, such as the 50-day and 20-day moving averages, are converging, which suggests that the pair is consolidating and looking for a direction. The Relative Strength Index, RSI, is currently at 55, which is neutral, indicating that the pair is not overbought or oversold. This suggests that we may see more range-bound trading today, unless there is a significant catalyst, such as a surprise in the economic data, to trigger a breakout. Now, let's move on to the most actionable part of today's broadcast: trading scenarios and strategies. Based on the factors we've discussed, we expect Australian dollar to US dollar to trade in a range of 0.7130 to 0.7200 today, with a neutral to bullish bias. Let's outline two main trading scenarios, bullish and bearish, and provide clear entry, stop loss, and target levels for each. First, the bullish scenario: buy on dips. This strategy is based on the expectation that risk sentiment will remain positive. The RBA's hawkish stance will provide support, and the US data will be weaker than expected. Here's how to implement this strategy. Entry. Look to enter a long position near the immediate support level of 0.7150 to 0.7155. This is a strong support level, and a bounce from here would confirm that the bullish momentum is still intact. It's important to wait for confirmation, such as a bullish candle close above 0.7155, before entering the trade to avoid false breakouts. Stop loss. Place the stop loss below the secondary support level of 0.7135. This level is below yesterday's low and the key demand zone, so if the pair breaks below this level, it invalidates the bullish bias and indicates that the pair may be heading lower. The stop loss should be tight enough to limit losses, but not so tight that it gets triggered by normal market volatility. Targets. The first target is the immediate resistance level of 0.7180. If the pair breaks above this level, the second target is the major resistance level of 0.7200. If the pair breaks above 0.7200, you can consider extending the target to 0.7220 to 0.7230, but it's important to take partial profits at each target to lock in gains. Second, the bearish scenario, sell on rejection. This strategy is based on the expectation that the pair will fail to break above the resistance levels, the US data will be stronger than expected, or geopolitical tensions will reignite. Here's how to implement this strategy. Entry. Look to enter a short position if the pair fails to break above the resistance level of 0.7180 to 0.7200 and show signs of bearish rejection, such as a bearish candle close below 0.7180. This indicates that there is significant selling pressure at the resistance level, and the pair may be heading lower. Stop loss. Place the stop loss above the major resistance level of 0.7210. This level is above the year's high, so if the pair breaks above this level, it invalidates the bearish bias and indicates that the pair may be heading higher. Again, the stop loss should be placed to limit losses while avoiding being triggered by normal volatility. Targets. The first target is the immediate support level of 0.7150. If the pair breaks below this level, the second target is the secondary support level of 0.7130. If the pair breaks below 0.7130, you can consider extending the target to 0.7100 to 0.7110. But again, take partial profits at each target to lock in gains. It's important to remember that no trading strategy is foolproof, and there are always risks involved. The key to successful trading is to manage your risk effectively. Never risk more than you can afford to lose, and always use stop-loss orders to limit your losses. Additionally, it's important to stay flexible and adjust your strategy based on real-time market developments, such as changes in risk sentiment or unexpected data releases. Now, let's address some of the most common questions we've received from our viewers this morning. The first question is, will the RBA really raise rates in May, and how will that impact the Aussie? As we mentioned earlier, the market is pricing in a 57% probability of a 25 basis point rate hike in May. If the RBA does raise rates, it would likely provide a significant boost to the Aussie dollar, as it would increase the interest rate differential between Australia and the US. However, if the PMI data today is much weaker than expected, it could reduce the likelihood of a rate hike, which would weigh on the Aussie. It's important to watch the RBA's commentary in the coming weeks for further clues about its policy stance. Now, let's take a moment to recap all the key points we've covered today. The Aussie dollar is currently trading at 0.7159, with a neutral to bullish bias. The key factors driving its movement today are global risk sentiment, supported by the Middle East ceasefire extension but vulnerable to geopolitical surprises, key economic data, Australia's PMI at 12:30 Greenwich Mean Time, US jobless claims and PMI later in the day, and China's PMI this afternoon, the RBA's hawkish stance, supporting the Aussie, and commodity prices, neutral to positive for the Aussie. The key levels to watch are 0.7130 to 0.7140, support, 0.7150 to 0.7155, immediate support, 0.7180 to 0.7185, immediate resistance, and 0.7200, major resistance. We expect the pair to trade in a range of 0.7130 to 0.7200 today, with potential breakouts depending on the economic data and geopolitical developments. For traders, the recommended strategies are to buy on dips near 0.7150 to 0.7155 with a stop loss below 0.7135 and targets at 0.7180 and 0.7200. Or sell on rejection at 0.7180 to 0.7200 with a stop loss above 0.7210 and targets at 0.7150 and 0.7130. Remember to manage your risk effectively and stay flexible. I also want to remind everyone that the content of this broadcast is for informational purposes only and does not constitute investment advice. Trading Forex involves significant risk, and you should always do your own research and consult a financial advisor before making any trading decisions. We are here to provide you with insights and analysis, but the final decision is always yours. As we move into the afternoon session, we'll continue to monitor all the key factors driving the Aussie dollar, including the economic data releases, geopolitical developments, and commodity prices. We'll also be answering your questions live, so feel free to submit them via our website or social media channels. In closing, today is a crucial day for the Aussie dollar, with a number of catalysts that could shape its movement. Whether you're a seasoned trader or just starting out, it's important to stay informed, stay disciplined, and manage your risk. The market is constantly changing, but with the right analysis and strategy, you can navigate these changes and find opportunities. Thank you for joining us today on Market Meridian. We'll be back with more real-time analysis and updates as the day progresses. Until then, happy trading, and we'll see you soon.